Good morning and welcome back to Almus Market Mornings. Our Treasury head, Mr. Pankaj Jati, mentioned to me last night, and I quote, "Precious metals are not so precious anymore today." Even though the West remains on the year-end holiday, we saw huge corrective actions in precious metals last night as gold fell by almost 5.5%, silver and platinum also fell by more than 15% from their peaks. While on the other hand, copper, which saw some corrective action during the day, seemed to remain comparatively strong last night. Good morning, Jayaram sir. What was the main reason for this fall last night, and where do you see this whole metal saga go from here into the new year?
Good morning, Eshan. It's not surprising to see such strong pullback in the metals because of the way they had rallied. And if you look at silver in the year, we have seen it gain over 150%, and gold as well, more than 100%. And we also had some other metals like base metals like copper, quite a few of them rally. Uh, uh, you know. Uh, Partially based on fundamentals, then based on investment demand, and of course, the speculative trading is always, coming into picture. Now, the speculative element in the recent days had taken over the volumes and also the price movement. So yesterday in the morning update, I did share that we are reaching a level where authorities would be concerned about the way prices are moving and the impact it would have on inflation and also the industries which are dependent on these metals. So we did see an action by the exchanges increasing the margins, and market always needs a trigger for taking profit, and that's what happened yesterday. Yes, because we had such a large move, even the corrections also would be large, and that is what we have seen yesterday. Nothing to say that these trends have ended. We have seen a similar correction, if not as much as this, but intense correction even in October, and that has been kind of repeated. We could continue a bit more on the downside, but I think long term demand for precious metals, particularly, which are serving as debasement route for the dollar holders. This will continue. Yes, Pankaj is right that for the day metals or the precious metals were not precious, but then eventually we will see the demand take over, and the long term demand and the desire to hold these metals will continue definitely. Yes, as we are closing in on the new year, just two more trading days, and effectively it will be like only one day, because tomorrow most of the traders wouldn't be available or they will not be available on the desk. So we are seeing some kind of random movements in the markets, nothing to read as a trend. Therefore, we should not read too much into the moves that we have been seeing in the past couple of sessions. And what we have, of course, had in the rupee, the trend of underperformance or weakening sense in the currency is continued. We are almost close to the 90 levels, about a rupee lower from the peak that we have seen. The demand is not abating, and the supplies are limited, requiring again the nationalist banks to come and offer dollars at about 89.90, staving off a break of 90 levels. It might well break today or tomorrow. But then, as we, look at the rupee, actually, rupee is in a very good place. Domestic economy is strong. Asset prices have consolidated for over a year. Currency has been undervalued. The REER is now closer to 95, which is a 5% undervaluation. Budget is around the corner, which should support growth and the financial markets. So I think investors would be stopping and then thinking whether it's worth selling the rupee at these levels. The risk reward is definitely going to be weighed in the favor of rupee. Of course, unless we have new challenges that come about in the new year. Yes, the concerns remain on the elusive trade deal as well as lack of capital flows, but these things can change with a couple of decisions. U.S. administration can change. As I mentioned yesterday, the reduction of import from Russia of oil from Indian oil companies has dropped to its lowest level for over last several months, and then as Russia-Ukraine peace talks progress, any end to the war or some sort of a ceasefire can also lead to the US not being in a position to justify its sanctions on India for importing Russian oil. So uh, and of course the investors in the new year can always go back and think whether uh, lightly position or very low position in exposure to the Indian markets might as well get some flows as well. So I think in the new year we should keep an open mind as far as the rupee is concerned. We could have some stronger pullback, a natural pullback without an intervention from RBI. By the way, we also had a very good number on the industrial production yesterday for the month of November, rising 6.7% on a year-on-year basis. And also, even on a month-on-month basis, there was a 4.5% uptick. It is quite a impressive number because in October we had recorded only 0.5% production. And manufacturing, which is about 78% of the industrial output, grew at 25-month high of 8% in November compared to 2% in October as well. So I think the activity level also has picked up. No doubt the festival demand and some sort of a base effect advantage would have worked in its favor, but it's a good number as we end the year. So just to repeat, I think rupee weakening more from here requires new, fresh negative factors. Yes, if the demand supply situation remains in favor of demand, then we could see a slow further depreciation. But then it is time to stop and think whether the rupee should weaken further, having already weakened more than 8% in this year, and more so while all other currencies have been getting stronger. On the global markets, we have focus on the FOMC minutes that would be published today. That probably is one of the last big release that would have from the US. So FOMC had cut the rate by 0.25% with three dissenters, but what would be looking for in the minutes is how diversified are the views of the members as far as the future actions on the monetary policy is concerned. That apart, I don't think we see much movement in the currencies, dollar and hovering in the slightly weaker range even after rate hike because people have a sense that the Japanese authorities would be going slow about their rate hikes, and of course the focus will be on whether euro continues its rally into the new year. That said, I think just a day to go. We I think we are in a very rangy situation, and that should probably be even slower market tomorrow. Thank you.
Thank you, Jayaram, sir. And just to summarize, this fall in the precious metals was expected at some point and not surprising due to the huge rally we saw during this year in metals, which was due to the demand for these metals, the speculative positions, and also global fundamentals supporting it. Thus, some profit taken was seen last night, which we also saw in October. But of course, this rally does not seem to end in the long term as the desire to hold these metals will continue at some point. And when it comes to dollar rupee, the trend of underperformance continues as we are closer to the 90 level again. And the rupee seems to be in a good place right now as the domestic fundamentals seem to be positive with the industrial production and also the manufacturing data that we received yesterday. And the asset prices are consolidating for now. And the RER fair value for the dollar rupee is now at 95. And if we see the Russia-Ukraine peace deal gets signed soon, the US may not be able to justify the trade sanctions on India. So hopefully we see some developments on that front in the new year. And when it comes to the global markets, we have the focus on the FOMC minutes tonight of the December rate cut meeting, which is a big final piece of data that we'll be receiving this year. So it'll be interesting to look out for that. Apart from that, we expect that the markets will stay pretty much quiet for today and tomorrow before we go into the new year. Thank you all so much for listening, and we'll catch up tomorrow with a fresh round of updates.